In the damp, salt-heavy air of Amsterdam in the late summer of 1602, the modern financial world was quietly, ruthlessly forged. To comprehend the sheer magnitude of the paradigm shift that occurred in the Dutch Republic at the dawn of the 17th century, one must first understand the brutal, high-stakes mathematics of the global spice trade. At the time, spices like nutmeg, mace, cloves, and black pepper were not mere culinary novelties. They were the ultimate geopolitical commodities, representing staggering, world-altering wealth. A single ship returning to Europe from the Moluccas, the fabled Spice Islands in the Indonesian archipelago, laden with a hold full of nutmeg, could yield profits exceeding 400%. It was the 17th century equivalent of discovering a limitless reserve of crude oil or achieving the singularity in artificial intelligence. However, the pursuit of this wealth was a terrifying binary gamble. Before 1602, Dutch merchants organized their expeditions through what were known as voorcompagnieën, or pre-companies. These were temporary single-voyage syndicates. A group of wealthy merchants would pool their capital to build a ship, hire a crew, and send them into the abyss of the oceans. The risk profile was astronomical. The journey took years, and the ships faced devastating typhoons, rampant scurvy that could annihilate half the crew, and the heavily armed, hostile galleons of the Portuguese Empire who violently defended their monopoly on the trade routes. If the ship sank, the capital was instantly, permanently vaporized, and the investors were completely ruined. If the ship returned, the syndicate was immediately liquidated, the massive profits were distributed, and the company ceased to exist. This fragmented, hyper-risky model was highly inefficient and threatened the survival of the young Dutch Republic. Recognizing that they were bleeding capital and losing ground to their imperial rivals, the Dutch government, the States General, stepped in and forced a radical, unprecedented consolidation. They ordered the competing merchant syndicates to merge into a single, monolithic, state-sponsored mega-corporation, the Verenigde Oostindische Compagnie, universally known as the Dutch East India Company, or the VOC. The VOC was granted a terrifying, sweeping charter. It was given a complete and absolute monopoly on all Dutch trade east of the Cape of Good Hope. But more importantly, it was granted sovereign powers. The VOC was legally authorized to build forts, maintain its own private standing armies, negotiate treaties with foreign monarchs, coin its own money, and wage offensive wars. It was a corporation armed with the lethal military capacity of a nation-state. To build the massive fleets of heavy East Indiamen required to project this global power, the VOC needed a volume of capital that no single syndicate of merchants could possibly provide. They needed to tap into the collective wealth of the entire Dutch populace. In August 1602, the directors of the VOC opened a ledger book in the East India House in Amsterdam and executed the World S' very first initial public offering. The true revolutionary genius of this event was its absolute democratization of risk. For the first time in human history, the opportunity to acquire equity in a massive wealth-generating enterprise was not restricted to the aristocracy or the banking elite. Anyone, regardless of social class, could walk into the East India House and pledge their capital. The ledger recorded the investments of wealthy patricians, but it also recorded the investments of bakers, blacksmiths, orphaned children, and household maids who pooled their microscopic savings. By the time the ledger was closed, the VOC had raised an astonishing 6.5 million guilders, the greatest concentration of private capital the world had ever seen. The investors had traded their physical gold and silver for a fractional, theoretical ownership stake in a sprawling maritime empire. But almost immediately, a critical, systemic problem emerged. Originally, the VOC charter stated that the company would be liquidated, and the capital returned to the investors after a period of 10 years. But as the VOC rapidly expanded, building permanent fortresses in Batavia and engaging in protracted, expensive wars with the Portuguese and the English, the directors realized they could not possibly liquidate the company. They needed the capital to remain permanently locked inside the corporate treasury. The 10-year liquidation clause was quietly ignored, and the investments were essentially frozen. The citizens of Amsterdam now held equity in a highly profitable company, but their money was entirely illiquid. If a baker needed his capital back to buy a new oven, he could no longer go to the VOC and demand his guilders. His only recourse was to find another citizen willing to buy his share. To facilitate these transactions, the citizens began gathering in the open air, initially on the Nieuwe Brug, New Bridge, over the Amstel River, and later in the specialized arcaded courtyard of the Amsterdam Bourse. This organic, desperate need for liquidity birthed the secondary market. It was the invention of the stock exchange. Citizens began trading the paper receipts of their VOC investments, negotiating prices based on the rumors of returning ships and the latest news from the East. The abstract concept of the share was now a fully tradable commodity, completely detached from the physical ships and the spices it represented. However, from the very first moment this market materialized, it was fundamentally, structurally rigged against the public. The public believed they were participating in a fair and open financial ecosystem. But the architecture of the VOC was designed to ensure absolute, unquestioned dominance by its corporate board, known as the Heeren 17th, the 17 Gentlemen. The Heeren 16th were the ultimate corporate autocrats. They possessed absolute control over the company's sprawling operations, its massive treasuries, and its military deployments. But their most devastating weapon was their monopoly on information. In the 17th century, information moved at the speed of a sailing ship. The directors of the VOC established an ironclad policy of absolute corporate secrecy. They were under no legal obligation to publish balance sheets, they held no open shareholder meetings, and they provided absolutely no transparency regarding the true financial health of the megacorporation. The thousands of ordinary citizens who had funded the enterprise were kept completely, deliberately in the dark. This total information asymmetry created the perfect, pristine environment for rampant, unchecked insider trading. The Heeren 17th knew the contents of the incoming spice fleets months before the ships ever reached the ports of the Netherlands. They received encrypted letters carried by fast dispatch boats detailing which ships had survived the journey and which had been claimed by typhoons. If a director knew that a massive, highly profitable fleet was approaching, heavily laden with thousands of tons of cloves and nutmeg, he knew the VOC would soon announce a staggering dividend. He would secretly dispatch his proxy agents into the courtyard of the Amsterdam Bourse. These agents would aggressively buy up the shares of ordinary, uninformed citizens at current market prices. When the fleet finally arrived and the massive dividend was publicly announced, the stock price would violently gap up and the director would pocket a fortune, effectively stealing the upside from the very citizens who had taken the initial risk. Conversely, if a director received early word that a fleet had been sunk or captured by the British, he would quietly dump his shares onto the unsuspecting public before the catastrophic news broke, leaving the bakers and the blacksmiths holding the bag as the price collapsed. The Amsterdam stock market was not an even playing field. It was a highly sophisticated extraction mechanism. The House held all the cards, and the public was simply providing the liquidity. But the manipulation was not limited to simple insider buying and selling. The lack of regulation and the intense greed of the era quickly spawned the invention of highly complex, incredibly destructive financial derivatives. The most notorious pioneer of these dark arts was a man named Isaac Lemaire. Originally one of the founding directors of the VOC, Lemaire was ousted from the company after a bitter dispute over corporate embezzlement. Consumed by a desire to exact financial revenge upon the Heeren 17th, Lemaire did not build a competing fleet of ships. He built a weaponized financial syndicate known as the Groot Compagnie, the Great Company, and in doing so, he invented the bear raid and the mechanism of naked short selling. Lemaire realized that he did not actually need to own shares of the VOC to destroy its market value. He and his syndicate began selling massive quantities of forward contracts, legally binding paper promises, to deliver VOC shares to buyers at a future date, at a significantly lower price than the current market value. Because they were selling shares they did not actually own, they flooded the market with artificial, synthetic supply. Simultaneously, Lemaire unleashed a coordinated psychological warfare campaign. He spread terrifying, fabricated rumors throughout the coffeehouses and the bourse. He paid men to whisper that the VOC fleets had been annihilated by the Spanish, that the forts in Batavia had fallen, and that the company was on the verge of total bankruptcy. The combination of massive synthetic selling pressure and manufactured panic completely broke the psychology of the Amsterdam market. The ordinary shareholders, terrified by the plunging prices and the rumors of ruin, began panic selling their actual physical shares. The stock price of the most powerful corporation on earth went into a violent, uncontrolled freefall. When the price finally cratered, Lemaire and his syndicate simply stepped into the open market, bought the heavily depreciated shares for pennies on the gilder, and used them to settle their original forward contracts, pocketing a staggering, astronomical profit. The Heeren 17th were absolutely furious. They had been outmaneuvered in the very casino they had built. In response to Lemaire's devastating bear raid, the directors did not demand greater transparency or fairer markets. Instead, they utilized their immense political leverage over the Dutch government to pass the world its very first piece of financial market regulation. In 1610, the States General officially banned the practice of naked short selling. This regulation was not enacted to protect the poor, uniformed citizens from volatility. It was enacted strictly to protect the equity of the monopolists from hostile financial attacks. The insiders had rigged the rules to ensure the stock could only go up, preserving their wealth while leaving the public entirely exposed to the asymmetric reality of the ledger. The stock market was born not as a democratic engine of shared prosperity, but as a heavily fortified, deeply opaque arena where the elite could leverage their monopoly on information to extract the capital of the masses. While the outright ban on naked short selling protected the monopolists from hostile financial attacks, It did absolutely nothing to protect the ordinary citizen from the systemic, structural exploitation engineered by the directors of the Dutch East India Company. The Heeren 17th had successfully fortified their casino, ensuring that the only direction the broader market could be manipulated was upward, which perfectly suited their massive, static equity positions. But the true, insidious brilliance of the VOC's rigged architecture was not merely found in how the shares were traded. It was found in the deeply predatory mechanics of how the corporation distributed its astronomical profits to the shareholders. Modern investors are conditioned to expect dividends to be paid in cold, hard cash, seamlessly deposited into a brokerage account. In the early decades of the 17th century, the VOC operated under an entirely different, highly weaponized payout paradigm. When the massive, heavily armed East Indiamen returned to the port of Amsterdam, their hulls groaning under the weight of hundreds of tons of Indonesian spices, the directors faced a logistical and financial dilemma. Liquidating that entire unimaginable volume of exotic spices on the open market all at once would violently crash the price of the commodities, destroying the company's profit margins. To solve this, the Heeren 17th frequently declared what was known as a dividend in kind. Instead of paying the shareholders in gold or silver bank guilders, the corporation paid the dividend in physical spices. If a citizen owned a fraction of a share in the VOC, they were legally entitled to march down to the massive, heavily guarded East India House warehouses and take physical delivery of bags of raw black pepper, mace, nutmeg, or cloves. To a casual observer, this might seem like a fair distribution of corporate treasure. In mathematical reality, the dividend in kind was a devastating wealth extraction mechanism, perfectly designed to strip capital from the working class investor and funnel it directly back into the pockets of the aristocratic elite. Consider the logistical nightmare this posed for the ordinary citizen. A baker, a blacksmith, or a mid-level merchant who received 50 pounds of raw black pepper as their annual dividend had absolutely no commercial use for it. They did not possess the sprawling, climate-controlled warehouses required to safely store the volatile organic matter, nor did they possess the international trade networks required to export the spices to foreign buyers in Germany or France. They were functionally trapped with a highly perishable, highly illiquid physical asset. Because they needed cash to pay their rent, buy food, and purchase the raw materials for their actual professions, the working-class shareholders were forced to immediately liquidate their physical spice dividends on the local Amsterdam spot market. When thousands of desperate ordinary citizens all attempted to sell their pepper and nutmeg on the exact same day, they created a massive artificial glut in local supply. The local price of the spices instantly, violently collapsed. Waiting patiently at the bottom of this engineered price collapse were the very same patrician merchants and VOC directors who had issued the dividend in the first place. These men possessed massive, empty warehouses situated along the Herengracht Canal. They possessed endless reserves of cheap credit from the Bank of Amsterdam. They simply stepped into the flooded spot market and bought the physical spices back from the desperate working-class shareholders at a fraction of their true global market value. The elite would then lock the newly acquired, heavily discounted spices in their secure warehouses, patiently hoard them to artificially restrict the global supply, and slowly sell them off over the next several years to European monarchs at astronomical, monopolistic markups. Through the mechanism of the in-kind dividend, the VOC successfully forced the public to absorb the market friction and the liquidity risk of the physical commodity trade, while the directors mathematically guaranteed that they would capture the ultimate top-line profit. The working class took the initial risk to fund the ships, but the elite rigged the payout plumbing to ensure the lion's share of the wealth never actually left their own balance sheets. As the 17th century progressed and the Amsterdam Bourse evolved into a sprawling, hyper-complex financial ecosystem, the appetite for speculation among the Dutch populace became insatiable, but physical shares of the VOC were incredibly expensive, locking out the poorest segments of society. To keep the casino operating at maximum capacity, the financial engineers of the Dutch Republic invented the foundational mechanisms of modern leverage. They built the tools of mass financial destruction that would eventually become the hallmark of every rigged market in human history. The first of these inventions was the prolongatier, the 17th century ancestor of the modern margin loan and the repurchase agreement, repo. If a speculator believed the price of the VOC was going to rise, but did not possess the actual capital to buy a share, they could execute a prolongati contract with a wealthy financier. The financier would loan the speculator the money to buy the stock, and the speculator would legally pledge the newly purchased stock itself as collateral for the loan. The speculator paid a fixed interest rate for the duration of the contract, usually a month. This mechanism introduced a terrifying, explosive dynamic into the Amsterdam market. Highly leveraged, uncollateralized risk. As long as the stock price went up, the speculator could sell the share, pay back the loan, cover the interest, and pocket a massive return on investment using money that never actually belonged to them. But if the stock price dropped below the value of the loan, the structural trap was sprung. The wealthy financiers who provided these margin loans were not doing so out of a desire to help the working class build wealth. They were executing a mathematically flawless strategy of risk-free asset acquisition. When rumors of a sunken fleet or a lost war reached the bourse and the VOC share price began to slide, the financiers would execute the 17th century equivalent of a margin call. The speculators, lacking the physical cash to cover the difference, were forced to default on the loans. The financiers would immediately seize the underlying VOC shares, the collateral, at a catastrophic discount. The prolongati system was a one-way ratchet, designed to systematically transfer the actual equity of the most powerful corporation on earth out of the hands of the leveraged public and permanently into the vaults of the creditor class whenever volatility struck the market. To further democratize this toxic leverage and extract fees from the absolute poorest citizens, the Amsterdam Bourse birthed the modern derivatives market. The Dutch invented the apremies, the trading of call and put options. An option contract gave a speculator the right, but not the obligation, to buy or sell a share of the VOC at a specific price on a specific future date, in exchange for paying a small, upfront, non-refundable premium. This was the ultimate financial narcotic. A chimney sweep or a dock worker who could never dream of saving 3,000 guilders to buy a physical share of the VOC could easily scrape together 30 guilders to buy an option premium. They were purchasing a highly leveraged lottery ticket, betting entirely on the short-term price action of the stock. This explosion of complex derivatives necessitated the creation of a brand new, highly parasitic professional class, the makelars, or the stockbrokers. The makelars were the middlemen who matched the buyers and sellers of these intricate paper contracts in the crowded, chaotic courtyard of the bourse. They were the ultimate beneficiaries of the rigged system because their business model was completely divorced from the underlying success or failure of the investments. They extracted a fixed commission on every single transaction. Whether the stock went to the moon on news of a record spice haul, or whether it violently crashed and wiped out 1,000 leveraged speculators, the makelayers in the house always got paid. They aggressively encouraged the public to trade as frequently as possible, spinning endless webs of rumors and counter-rumors to generate the volatility required to churn the accounts of the working class and harvest their commissions. The absolute fragility and the inherent cruelty of this highly leveraged, heavily manipulated market architecture were finally exposed to the world in 1672, a period permanently etched into Dutch history as the Rampjaar, or the disaster year. The Dutch Republic, having grown incredibly wealthy and arrogant on the profits of the VOC and the global spice trade, found itself completely surrounded by hostile empires eager to crush its economic dominance. In the spring of 1672, a massive coordinated military alliance consisting of the French Empire under King Louis XIV, the English Navy, and 2 German bishoprics launched a devastating multi-front invasion of the Netherlands. The French army, hundreds of thousands strong, smashed through the eastern defenses and marched relentlessly toward Amsterdam. As the reality of total existential annihilation gripped the Republic, the Amsterdam Bourse experienced the first true systemic macroeconomic market crash in human history. The illusion of perpetual leveraged wealth evaporated in an instant. The citizens realized that paper contracts for future deliveries of nutmeg were entirely worthless. If a French artillery battery was actively burning down the warehouse, a frantic, apocalyptic stampede for liquidity began. Every single participant in the market attempted to sell their shares and their options simultaneously, desperate to convert their paper wealth back into physical gold and silver so they could flee the country. The price of the VOC, the untouchable titan of global commerce, went into a terrifying, uncontrolled death spiral. The intricate webs of prolongati margin loans violently unwound. As the stock price plummeted, thousands of margin calls were triggered simultaneously. The working class speculators defaulted en masse, their entire life savings incinerated in a matter of days. But the Heeren 17th, the aristocratic directors who had designed the rigged game from minute one, did not panic. Their vast generational wealth was not tied up in highly leveraged short-term call options. Long before the French troops crossed the border, the directors, utilizing their superior political and military intelligence networks, had quietly unloaded their excess speculative positions onto the uninformed public. They had converted their wealth into physical gold, secure real estate, and hard assets. When the market utterly collapsed during the Rampjaar, wiping out an entire generation of working-class wealth, the corporate entity of the VOC simply suspended its dividend payments to preserve capital. But critically, the directors refused to suspend their own massive guaranteed management salaries and administrative bonuses. The public was left holding the worthless, uncollateralized paper of a burning empire, while the architects of the market retreated behind the flooded waterlines of the Dutch defenses, their fortunes completely intact, waiting patiently for the smoke to clear so they could buy back the world for pennies. Following the catastrophic shock of the Rampjaar in 1672, the Dutch East India Company did not instantly vaporize. It entered a prolonged, agonizing, century-long terminal decline, transforming from the most terrifyingly profitable enterprise on Earth into the world's first systemic zombie corporation. Stripped of its absolute military dominance in the East by the rising British Empire, and staggering under the weight of massive administrative bloat, the VOC's core spice trade ceased to generate the astronomical profits of its golden era. But the aristocratic Huron 17th, the 17 gentlemen who completely controlled the corporate machinery, refused to let the entity die. They needed the illusion of the VOC to maintain their own social standing and to facilitate their endless, highly lucrative financial games on the Amsterdam Bourse. To keep the stock price artificially elevated and prevent a total panic among the remaining shareholders, the directors resorted to the oldest, most destructive trick in the history of centralized finance: massive systemic accounting fraud. Because the VOC was a sovereign monopoly entirely immune to independent public audits, the directors simply cooked the ledger. They began issuing dividends not from the actual profits of the spice trade, which were rapidly shrinking, but by taking on staggering amounts of short-term, high-interest debt from the Bank of Amsterdam. They were borrowing newly printed bank guilders to pay off the existing shareholders, mathematically transforming the world's premier shipping conglomerate into a state-sponsored Ponzi scheme. And the working-class citizens who bought shares in the late 17th and early 18th centuries were not investing in a productive enterprise. They were providing the exit liquidity for the patrician class. By the time the VOC finally, officially collapsed into bankruptcy in 1799, its shares were entirely worthless, and it left behind a debt so colossal that it had to be nationalized by the Dutch government, transferring the catastrophic losses directly onto the backs of the taxpayers. But the true, lethal legacy of the Dutch East India Company was not the spices it brought back to Europe. It was the financial algorithm it perfected. The architecture of the rigged market, the fractionalized shares, the opaque ledgers, the margin loans, the options contracts, and the absolute dominance of the insider did not die with the VOC. It migrated. In 1688, during the geopolitical upheaval known as the Glorious Revolution, the Dutch stadtholder William of Orange crossed the English Channel with a massive invasion fleet to take the British throne. He did not merely bring soldiers, he brought the finest, most ruthless financial engineers of Amsterdam. The virus of the rigged casino was injected directly into the heart of London. Within a few short years of William's ascension, the British copied the Dutch blueprint with terrifying precision. They established the Bank of England to monopolize the issuance of debt, and they chartered their own sovereign megacorporation, the English East India Company. The smoky, chaotic taverns of Exchange Alley in London became the exact mirrored reflection of the Amsterdam Bourse, complete with the same insider trading, the same engineered panics, and the same highly leveraged derivative traps designed to strip wealth from the uninformed British public. This exact same architecture was then exported across the Atlantic, where in 1792, 24 wealthy brokers signed the Buttonwood Agreement under a tree on Wall Street, establishing the New York Stock Exchange. The founding document of Wall Street was explicitly designed to create a closed, elite cartel that excluded the general public from the true mechanics of price discovery, forcing all retail trades through brokers who extracted mandatory, non-negotiable commissions. Today, the modern retail investor operates under the incredibly dangerous psychological delusion that the stock market has been fundamentally reformed. We are taught that the creation of the Securities and Exchange Commission, the implementation of complex financial regulations, and the digitization of trading have leveled the playing field. This is the greatest, most successfully executed public relations victory in the history of global finance. The game was never reformed. It was simply obfuscated behind impenetrable layers of algorithmic complexity and legal jargon. The Huron 17th did not disappear. They simply traded their silk doublets for tailored suits and their fast dispatch ships for microwave towers and fiber optic cables. The absolute core weapon of the elite, the monopoly on information and the asymmetry of speed, is more powerful today than it was in 1602. In the 17th century, a VOC director possessed a multi-week advantage by receiving a letter from Batavia before the public. Today, massive high-frequency trading HFT firms co-locate their supercomputers directly inside the data centers of the national stock exchanges. They pay astronomical fees to ensure their servers are physically inches away from the exchange's matching engines. This allows them to execute trades in microseconds, millionths of a second, gaining a terrifying, mathematically insurmountable advantage over the retail investor sitting at home on a smartphone. When you tap a button on a modern trading app to buy a share of stock, you believe you are participating in a free and open market. You're not. Your order does not go directly to the exchange. It is subjected to a modern extraction mechanism known as payment for order flow, PFOF. The supposedly free retail brokerages sell your order data to massive wholesale market makers before the trade is ever executed. These market makers use their supercomputers to view your incoming order, step in front of it, buy the stock fractions of a cent cheaper, and sell it to you at a microscopic markup. They arbitrage the spread millions of times a day, extracting billions of dollars in risk-free profit entirely from the friction of your trades. You are not the investor, you are the product. It is the exact same systemic front-running that the Dutch directors utilized in the courtyard of the Amsterdam Bourse, simply automated by artificial intelligence and perfectly legalized by the regulatory state. Furthermore, the true massive volume of institutional wealth is not even traded in the public markets. To prevent their massive block trades from moving the price and alerting the public, modern financial titans execute their buying and selling in dark pools, private, highly opaque, off-exchange trading venues where prices and volumes are completely hidden from the retail market until after the transactions are finalized. The elite trade in the shadows, executing their strategies with absolute secrecy, while the working-class retail investor is forced to trade in the lit markets, their every move broadcast, analyzed, and algorithmically hunted by predatory quantitative funds. Even the modern sanctuary of the working class, the passive index fund and the 401k, is a structural trap. When you passively invest in an index fund, you do not actually own the underlying shares of the corporations. You own a synthetic derivative managed by massive, monolithic asset management firms. These institutions absorb the trillions of dollars of working-class capital and use the combined voting power of those shares to completely dominate the corporate boards of every major company on Earth. They extract billions in management fees, dictate corporate policy, and consolidate global economic control, all while utilizing the capital of the very citizens they are subjugating. The terrifying reality of the global financial system is that the architecture established in Amsterdam over 400 years ago functions exactly as it was mathematically designed to function. It is a highly efficient, perpetually running vacuum, engineered to socialize the massive risks of global capitalism onto the backs of the working class, while relentlessly privatizing and concentrating the profits into the hands of a microscopic, deeply entrenched financial aristocracy. You cannot beat the casino by learning to play their game better than they do. They own the servers, they write the algorithms, they purchase the regulators, and they see your cards milliseconds before you even realize you're holding them. To survive the modern iteration of the Dutch disease, the individual must execute a radical, uncompromising financial secession. You must structurally decouple your life savings from the rigged architecture of the centralized exchanges. This requires transitioning your wealth into bearer assets, property that possesses no counterparty risk and requires no permission from a centralized broker to hold or transfer. Physical gold and physical silver remain the timeless, unprintable anchors of financial sovereignty. When you hold physical bullion outside of the banking system, you're holding absolute, untethered wealth that cannot be front-run by a supercomputer, cannot be diluted by a corrupt corporate board, and cannot be halted by an exchange circuit breaker. It is a silent, undeniable rejection of the paper casino. More importantly, the invention of Bitcoin provides the ultimate cryptographic antidote to the legacy of the VOC. Bitcoin is a decentralized, peer-to-peer monetary network with a completely transparent public ledger. In the Bitcoin protocol, there are no dark pools. There is no payment for order flow. There is no Heron 16th with the power to alter the supply cap or vote to dilute your purchasing power. Every single participant on the network, from a retail holder with $50 to a billionaire with 50 million, operates under the exact same immutable mathematical rules. The invention of the stock market was not the dawn of financial liberation. It was the dawn of industrialized financial extraction. The illusion of the fair market is the chains that bind the modern citizen to the wheel of perpetual debt and stagnant wages. The only way to win a rigged game is to stop playing it entirely and to move your wealth